Hi, everyone. Thanks for taking some time out to be here today. My name is Peter Krauth, and I'm going to talk about the huge opportunity that I see in silver and precious metals junior stocks. And I'm going to talk a little bit about, give you the groundwork, I guess, in terms of how I see challenges and what kinds of opportunities there are. So I've been saying for about a year that inflation is going to be the single most determining factor for investors for at least a decade. In fact, other than capital preservation, I think that inflation is going to be the biggest challenge. And that's why I call inflation enemy number one. Capital preservation, obviously, you can do that to some extent through cash. But as we know, inflation will eat away at it. And so cash is good for limited periods of time. But then inflation certainly is a big challenge. And we've heard lots of well-informed and very successful investors, hedge fund managers and so on, saying that over the longer term, at least, cash is trash and you really need to look for hedges. So the environment that we're in, if you look at just since the start of this year, we're off to the worst start for stocks and bonds. A 60-40 portfolio of 60 stocks, 40 bonds is actually the worst start to the first 10 months or the first 9 months since 1976. So the way I see it, the 60-40 portfolio and the bond and stock bull markets that have been tremendous 40-year secular bull markets are actually over at this point. It doesn't. It takes a lot these days to surprise me when I hear some economic news, but this one certainly did. When I had heard that 157 million Americans, which is 61% of the adult population, now lives paycheck to paycheck. And if you look at this chart, this is the chart of inflation in the US. So as you can see from about the middle onward until near the right end, inflation averaged about 2% in the US. And you could probably remember the Fed talking about how it was so anxious to try and get inflation at 2%, and even they'd be ecstatic if they got it above. Now we're at 4 times that level. We're at 8%, and they're not so thrilled. They got what they wanted, but it's not quite the way they wanted it. And so there are lots of implications if you look at how employment has played out over the last say 2 to 3 years. Certainly employment levels are high. Unemployment is low. That has actually changed in the last few months. There have been some relatively surprising numbers coming out. We're actually at a little bit of shocking levels in terms of first-time benefits applications. And as you can see from this chart, the labor participation rate is actually still well below what it was pre-pandemic. So the problem with low employment, people, as we all know, there are labor shortages everywhere. And the problem with low employment overall is that you have falling tax revenues, you have lower spending, and that eats into the government's budget. And it certainly makes a lot of industries quite challenging. So this is a great chart that shows one of the best analogs that we have, which is inflation through the 1970s. So the white line is what happened in terms of inflation. As you can see, it came in 3 waves. It wasn't a straight line up through the 1970s. So each time inflation came along, the Fed would try to fight it by raising rates. But there are consequences, the unintended consequences. And so the red line is unemployment. As you can imagine, as inflation goes up, that makes the cost of living higher for people. They spend less. That affects business. Business has less income. Business is also challenged with higher interest rates. And so businesses start to lay off. So it's not difficult to make the loop and understand why you have higher unemployment when you have higher inflation. And so the red line is the rate of inflation, the rate of unemployment. And there's a lag. The lag is has been at least in the 1970s, anywhere from about a year to 2.5 years from the moment that inflation starts to really pick up. So if we look at the current situation, inflation really started to pick up about a year and a half ago. So we're really getting close to where unemployment can really start to tick up. And if you couple that with aggressive rate hikes, well, that certainly is quite the recipe. To give you some perspective, elsewhere, Germany, for example, right now is at nearly 11% inflation. That's a 70-year high for the country. The Netherlands is facing 17% inflation right now. That's the highest they've ever recorded. And across Europe, inflation is high. In the Baltics, Latvia, Lithuania, Estonia are all above 22%. You have Poland at 17%, and you have multiple other Western European countries that are at 12% or even higher. So that just wreaks havoc with the economy. As we know, Europe is in an energy crisis. Prices have skyrocketed. People and businesses are paying anywhere from up to 10 to 12 times what they were paying a year ago in terms of energy. And again, that just is impossible for some businesses to deal with. They've had to, in many cases, just shut down because they realize that there is absolutely no way they can pass these costs on to their customers. And through all of this, the ECB is way behind. We complain perhaps the Fed is too aggressive and perhaps the ECB is too dovish. And so rates with the ECB are at 1.25%, and yet they expect the average inflation in Europe this year to be 8%. So that's a huge gap between the inflation rate and between the current ECB rate. And they've, in fact, besides expecting inflation to average 8%, they recently revised their growth rates for the economy lower. So that really does not bode well for Europe either economically. And so they all talk about fighting inflation. They talk a lot about fighting inflation, but they realize there's very little they can do. And in fact, if you look at what they are doing, it's more like the opposite, because they're doing a whole lot of spending, and that's why even with rates rising, this is in Europe, it's in the West, in Canada, in the U.S. Again, rates are rising. Fed fund rates, central bank rates are rising, but the spending is there to balance it, and that's what I think a lot of the market is missing. If you look at the UK, for example, because of course energy has skyrocketed. They have a $100 billion program for just the next 2 years to help cap home energy bills. Because of aggressive rate hikes and how that has hurt their bond market. This was just last week. Most people are aware. That was a crisis in the bond market in the UK. And to counter that, they announced a $65 billion program to bail out long-term bonds. So that's just the UK. You have Germany, for example, that's the largest economy in Europe, and that's dealing with a huge energy crisis. And to help, again, quotes, fight inflation, they have a $2 billion spending energy relief package. So the spending is there by far and many times over, I believe, to compensate for any kind of increases in spending for the average person. And I really don't see how any of this is going to help. It's only going to exacerbate the situation with inflation. And through all of this, there's something called the dollar milkshake theory. A guy by the name Brent Johnson came out with a while back, and it says that when you have one of the major, or actually when you have the US dollar raising rates, then it actually attracts the capital. And so his analogy is a milkshake with a straw in it. And so if it's the US dollar that has the biggest straw, and as they suck out through that straw the milkshake, then it drains away the values of the other currencies. And so we've certainly seen that in the last sort of 6 to 12 months with a lot of the other major currencies around the world that have dropped precipitously. So I mentioned before the Fed is very aggressive with its rate hikes. It's the most aggressive that it's been in modern history. That line on the left, the black line that shows 2022, shows you how sharply Fed rates have increased compared to prior rate hiking cycles. So that's a shock to the economy, and it's going to have some important consequences. I think we're very soon about to see how that's going to play out. So people ask me often, what could cause a pivot by the Fed? What could stop Fed rate hikes? Well, this is at least one major contributor, I think, a potential contributor. The Fed, that actually needs to be updated. We're actually officially at 31 trillion now in debt, a dubious milestone nonetheless. But and so the deficit, the budget deficit is $1 trillion as we are, and at 2%. The federal government spends $600 billion in interest payments alone. So with rates moving up, and if you, for example, calculate at about 3.5%, you're looking at about $1 trillion in funding the debt through interest payments. So your deficit from going from 2% to 3.5%, your deficit can double from $1 trillion to $2 trillion. This is the kind of thing that leads to something called modern monetary theory, where you just monetize the debt, print away. But these things certainly catch up to you, and sadly, I think we're about to find out pretty quickly how that plays out. This chart is interesting because it shows what's happened in the past, and that is how when the Fed tried to fight inflation, it would raise rates, but it would typically raise rates above the inflation rate. Today, the Fed funds rate is at 3.25%, and yet inflation is around 8%. So that's, again, a huge gap. Very, very difficult, very challenging for the Fed to be able to close that gap and get inflation back down. I really don't see them being able to do that. And an interesting point is that it's not the inflation. There is demand, there's no question about it, but the inflation is mostly from a lack of supply. And so assuming demand has stayed constant and supply has fallen from supply chain issues globally, that's been, I think, the biggest contributing factor to inflation. And there's no way that trying to slow demand is really going to help that. You need to ease off restrictions on supply issues and distribution and so on. So I think inflation is going to remain high. We talked about Europe. Now I'm going to talk about the US, for example. They're doing their own spending despite the Fed raising rates to try to slow things. There's the student loan bailout program that's expected, as per the Congressional Budget Office, is expected to cost nearly $330 billion over the next 10 years. Then you have the misnomer Inflation Reduction Act. That's going to do a few things. It's supposed to reduce carbon emissions by 40% by 2030, but it's also $370 billion of spending for renewable energy and for climate measures. And something we're going to get into a little bit more after is the implications for the solar industry because of the spending on renewable energy. But all that to say that there's a lot of spending going on despite raising rates. So, again, I see this as something that the market really is missing. So if we switch gears quickly, why silver? And hopefully I'll make the case for why precious metals, silver in particular, and juniors are in a fantastic sweet spot right now, both to help preserve capital, but also to help fight inflation. Silver has proven itself over not just centuries, but millennia as a fantastic inflation hedge. And if you look, for example, just going back 1 century, so 100 years ago, silver was priced at 68 cents per ounce. And if you use the US's own CPI inflation calculator, you would have silver at about $12 today, and yet we're closer to $21. So silver over a century has actually doubled the official inflation rate. So it's done a fantastic job. There's no question that it's volatile, but over longer terms, it has absolutely helped to preserve capital. What really makes silver tick, very much the same as for gold, are real rates. So when you have the real inflation rate, that's the rate, the risk-free rate of return on a government treasury, and you subtract inflation, you have the real rate. And so when that is in either a falling mode or a below zero mode, you have very positive conditions for silver. And that's what happened in the last 3 years, 4 years or so. In late 2018, real rates started to fall. You see at the bottom, the gray line, silver started to take off. It moved sideways in the latter part of 2019. But then when COVID hit and rates were cut, inflation took off. Silver actually reacted before inflation took off, probably about 6 to 9 months before, and then moved in a sideways range. We're obviously at the lower end of that range right now, but moved in a much higher sideways range from arguably about $12 to about $24, let's say average, in the space of a few months. So as I say, real rates are really what makes silver tick. This is probably one of my favorite charts in this presentation. So if you would ask the average investor, the average person or the average investor, what's been the best place to have your money invested over the last, say, 22 years since 2000, almost invariably the answer is going to be stocks. And yet, if you look at the record, that is wrong. Bonds are up about 24% since 2000. These are long-term bonds, say 20 year or so. The S&P is up 144%, so that's stocks. Not bad, but 144%. Silver's up 250% since 2000, and gold is up 477%. So the precious metals have dramatically outperformed both bonds and stocks for the last 22 years. We also know from research that precious metals and mining stocks outperform in inflationary periods. That yellow oval at the top shows you that precious metals and mining stocks tend to, at least half of the time, tend to outperform during inflationary periods, and the returns tend to be close to about 9 to 10% on average. The only other two sectors that are up there along with precious metals and mining are energy and REITs. So this is certainly an attractive sector in this kind of environment. For a little bit of perspective, if you look at what happened over the last few decades and bull markets, you could see in the 1970s that big scoop at the bottom in the middle, 1960, 1970, you can see the gold to S&P ratio bottoming over a long period and then absolutely exploding. So that was gold taking off and dramatically outperforming stocks. We had a similar action take place in 2000. And I believe that, and we had a fantastic run in stocks, gold stocks and gold, precious metals in general over the next 10 years. And I believe we're setting up for a similar kind of situation right now. If you look at how silver has performed since 2000, it's actually averaged 8.7% annually over the last 22 years. Now, there are two lines here. The gold line is actually the silver price in US dollars. And then the dark blue line is actually the silver price in a basket of major currencies around the world. So what this tells us is that although many people watch the silver price in US dollars, it's actually outperforming the US dollar price around the world, and that's what most people see. And so silver is really not all that far from its 2011 high, and if you look at it in a basket of major currencies. So it's really actually performed quite well. If you adjust for inflation, silver is actually 85% below its 1980 high. If you don't adjust for inflation, so that high was, say, $49, $50, silver is still more than 50% below that high. Silver is very cheap. Silver is the only major metal, if you look at precious metals, that includes the platinum group metals. If you look at base metals as well, it's the only metal that is still below its 1980 high. And so it has a whole lot of room to make up, to catch up to its peers. We know, again, from research that silver outperforms gold in bull markets, in precious metals bull markets. And silver really is unique when you look at metals in general. It's the only metal that is both what we call a monetary metal that's been used as money for thousands of years, and it's also an industrial metal, and it's roughly 50-50 in terms of industrial applications versus investment. And as I say, it's historically undervalued, and it's very critical these days in the green revolution, and I'm going to talk about that a little bit more. As I say, it has a lot of industrial applications. The single biggest application for silver on the industrial side is solar panels. 113 million ounces out of an annual supply of silver of roughly 1 billion ounces. So that's 12% of all the silver every year goes into one application, solar panels. It's crucial in automobiles as well. It's in all kinds of applications inside of automobiles. And EVs that are climbing in terms of sales and adoption use twice as much silver as the internal combustion engine vehicles. And so we're currently around 60 million ounces consumption per year for the automotive industry, and that's expected to rise to about 90 million ounces in just the next 3 years. On the electronics side, printed and flexible electronics, that consumes about 50 million ounces a year. That's also expected to rise about 50%, and that's over the next sort of 8 years. And silver is crucial in medicine, and there are developments coming about almost on a daily basis in terms of applications that are found for medicine. It's truly fantastic. It's a biocide. It kills bacteria. It limits infections. It's embedded in medical equipment. You have it in cornea replacements and contact lenses. So it's really indispensable in medicine. And that tells us why silver is finding the supply side very challenging. The Silver Institute tells us that in 2021, there was a shortage of 50 million ounces. That's about 5% of the annual supply. This year, it's expected to be about 72 million ounces. I think they're going to revise that higher probably in the next little while. And they're forecasting deficits for this several next few years. Let's dig into solar a little bit because it's the single biggest application. So between 2013 and 2021, the demand for silver grew tremendously from solar, which saw installations go up by 125%. In the last couple of years, the application solar demand was up 13% in 2021. It's forecast to be up another 12%. I think that's also going to be revised higher. And what's interesting about this chart, the green bars are the solar panel installations. The orange line is the silver loading. So that's the amount of silver that's required per solar panel. And that's been dropping over the last decade, but flatlining as well, because there's only really so much they can remove in terms of silver to cut costs and still keep the efficiency and make the panels work well. And so we've also seen that the next technologies in solar panels are likely to require as much as 50% more silver, and the technology expected to follow on that should require as much as 150% more silver. So the outlook for silver from the solar industry is tremendous. And here's a forecast from the International Energy Agency. So if we go back for a second, right now, solar consumes 12% of all of the silver every year. And yet, solar represents just 3% of global electricity. The International Energy Agency forecasts that solar installations are going to be up 8.5 times from current levels in just the next 8 years. So if you do the math, and solar consumes already 12% of all the silver supply, and it's going to be up by a factor of 8.5 times over the next 8 years, then it would technically consume all of the silver by then. So the pressure on silver and silver prices is going to be tremendous. If we switch gears a little bit, and we look at how the miners have performed in the market against the market in general. In the 2000 to 2011 market run-up, the multiple was 12 times versus the S&P. And I think we're setting up for something similar again this time, where the S&P is actually starting to fall, and gold is holding very well, and it's going to start to we're going to see the same sort of thing play out. silver miners versus gold miners. In the last about 4 or 5 months, we've seen the silver miners have started to outpace the gold miners. When silver starts to outpace gold, that's a suggestion that both markets, the silver and the gold markets, are starting to are likely to accelerate. Now we're going to dig in a little bit more in terms of where the specific opportunity exists. So positive cash flow, we've found if you net cash flow after inflation, the miners, the gold and silver miners, are the only sector, the only subsector of the S&P that have seen positive cash flow after inflation, which is just a tremendous thing to consider. And that cash flow has been rising incredibly over the last 2 years since, of course, precious metals prices have exploded higher. At this point, more than 70% of miners have positive free cash flow, meaning they're churning out fantastic profits, but they're not spending that money. If you look at silver miners specifically, the capex has fallen over the last decade. In 2021 alone, it fell 18% year over year. And so they're making money, as I say, but they're really not spending it. I think that they're gun shy because the last cycle punished them pretty badly. So they're a lot leaner today, and that helps them drive a lot of profits. The problem is that they're not replacing their reserves. And they need to do a lot of spending to catch up. The yellow line is the gold price. And if you look in the last cycle, 2000 to 2011, you can see through the blue bars that that's the capex spending. And that pretty much kept up with the gold price. And now we have a gap forming since about 2012, 2013. The gold price moved sideways, capex fell off, and now the gold price has run up again, and the gap has gotten even wider. And so one of the problems is that the precious metals miners are spending. The black line is the spending in the last couple of decades. And we're at about $6 billion for gold miners annually to look for gold. The thing is that they're spending this money mostly in their own brownfields projects. They're looking around where they have mines, perhaps doing some further exploration around their mines, below their mines, but they're not really so much spending on greenfields exploration to try and discover new potential deposits. They've actually delegated that role to the juniors. And so over the last, say, decade or two, it's the juniors that have really made the bigger discoveries. And if you look at the M&A aspect of this, there is also a huge gap. Again, in the late 2000s, from about 2007 to 2011, 2012 or so, there was big spending in M&A when, of course, the gold price rose dramatically, and miners started to buy juniors that had made discoveries because they needed to replace their reserves. So if you look at the blue bars all the way over on the right in this chart, that hasn't happened yet. It's just been a minor tick upwards last year. But I think that this gap is going to close. The precious metals miners that are throwing off a lot of cash flow are seeing their share prices improve. They're going to use their share prices as a currency to help them buy juniors that have made discoveries. So I believe M&A is coming. Anecdotally, Keith Neumeyer, who is the CEO of First Majestic, recently was interviewed on Kitco and said that they're actually looking to add a nice, juicy silver mine to their portfolio. So I believe we're going to start to hear a lot more of that. In the last few days, Monday, Tuesday, just of this week, silver had a couple of days in a row of tremendous return, plus 8%. Just the Monday return was an outsized return that hadn't happened since 2008. And when you had these kinds of returns that last time around, 14 years ago, that was followed by a 400% return in silver. And so that certainly looks pretty exciting. In terms of forecasts, you have some well-known and lesser-known analysts. Rick Rule is expecting that in the next 5 years, we're going to see $50 silver. Keith Neumeyer of First Majestic says we're going to see triple-digit silver in this cycle. Citigroup sees $40 in a year, $50 to $100 in the coming years. Gehring and Rosenzweig is actually predicting $500 silver this decade. Chen Lin, a colleague of mine, actually says silver is the next lithium, and that anyone who sells it at $30 to $40 is going to regret it. And myself, perhaps a little lesser known, Peter Krauth, I think silver is going to reach $300 in this bull market. And in fact, a few months back, I published a book called The Great Silver Bull. You can find that on Amazon. But I really lay out the case for silver. I talk about the economic background. I talk about the supply and demand dynamics. And then I talk about how the opportunity is playing out and how silver is extremely undervalued, and how I see multiple ways that we can very much easily get to as high as $300 in a blow-off peak in the price of silver. And so that concludes my talk. I write a newsletter called Silver Stock Investor. If you want to follow me, you can certainly find more information there. You can also follow me on Twitter and on LinkedIn. And thanks for taking the time.